Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey Curtis, everybody.
Hey Lauren, as we tape this video in early September of 2013, I saw an interesting article in the USA Today business section.
Okay.
And the headline was, "Look out for a September swoon. Lots to worry about in a historically bad month for the stock market."
Oh, okay.
And so I wanted to get your, the meat of the article was they gave some reasons why it could be a very bad month they're predicting for stocks.
Okay.
And then I wanted to end the video with what you and I think is the way to react to these type of articles and how to manage people's long-term investment portfolio. But here they said that the headline was, or the first paragraph says, "Is the stock market setting up for a big fall as the summer turns to fall?" And they call this the wall of worry, and they say that the seasonal setback is, of all the months, September has historically been the worst month for stocks. Over the past 100-year period, 50-year period, and 20-year period, the Dow Jones has actually showed a negative return for the only month of the year, September. Okay, and then they're also talking about some of these potential events like the war with Syria,
right?
The debt ceiling issues coming up again on October 15th. And worried that Ben Bernanke is not going to is going to continue to taper off the bond buying program. Okay. And then the potential currency crisis because the Fed is scaling back its cheap money policy. So these are all the reasons they say that we may be looking out for a bad month, September.
Right.
What's your comment on that?
There's 12 months in the year, and one of them has to be the worst.
Okay.
That's statistically necessary. I can prove it without looking at any history.
Okay.
If there are 12 months, there has to be a worse one.
Okay.
You can't really tell, unfortunately, whether it's the worst one by luck or because that there's some important reason. As far as all the things that they talked about, those are all legitimate threats, and everybody already knows all about them.
Yeah.
So
it's
whatever,
already built into today's prices.
Right, and so it's already built into today's prices. The only thing that would cause the market to move with any of those worries is if things turned out to be much worse or much better than people expect now.
Right.
And there's no way of knowing that.
Right. And then the other thing is well, there's two things that can happen. We could end up having a bad month. Right. Or we could end up having a good month. Right. As of now, the first few days in September, the newspaper is wrong because we were actually up. The market's up. But my takeaway is that whenever the news media says something, I almost like to do the opposite of what they say for one thing. But what do long-term investors, what should they be doing with their portfolio? That's really the important thing in this video.
Well, if it's time to rebalance, stocks are still probably up since the last time you rebalanced, whenever that was, unless you have very short time frames for rebalancing. But if September turns out to be a bad month, and if it turns out to be bad for a little while, then actually you'll buy more stocks.
Right. That's a great opportunity to rebalance and buy things cheaper. Okay. So yeah, and I think the final takeaway is all these perceived risks add to what we call the cost of capital, and so that with risks that there potentially are opportunities.
Yes. That's exactly where higher returns come from. That's where the phrase "the market climbs a wall of worry" comes from. Right. I mean, it doesn't always, but when there are more risks or when people perceive more risks, that's actually when expected returns are higher. Right.
So thank you very much for watching this episode. If you feel concerned about this unnecessarily, please contact Lauren or myself. We'll be happy to help you guide you through your plan. But thank you for watching this episode of Erickson TV. Bye now.
See you next time.